you would always want to be on the side of having good credit.
Do you think it pays to have good credit? Okay, y'all, in this episode of It Pays to Have Good Credit, we are bringing on the owner of Solid Foundation Finances. Man, how you doing today?
Man, I'm doing good, brother. What about yourself?
Doing well. Just a little cold here in the Phoenix, Arizona area, man. We just moved here a few months ago, and coming to the desert from Louisiana, I didn't know it would get so cold here. But man, we woke up this morning, it was 38 degrees outside, and I almost had to get my jacket for a second, but it's slowly warming up, man. But other than that, I want to make this episode to go over a few financial topics that's been sparking the interest all over the internet from people that's in this field. There's been rumors of mortgage companies no longer requiring credit scores. We're going to go over some of the crazy laws that us in the credit repair industry must follow. So we're going to break it down, go one by one, and just get opinions from both of us here, man. So the first thing I want to go over is Fannie Mae removing credit scores from mortgage applications. Now, some of this, in my opinion, is a little misleading. So I believe it's stated that as of November 16th, 2025, based on the last time I looked at it, not sure if it changed or not, but it stated that they are no longer going to require a minimum credit score. I believe the previous minimum score was 620 or 640, something like that. And they are going to remove that. So now people with 500 credit scores can so-called get approved for a mortgage. But once I actually read into details of that, it pretty much stated that the actual score isn't going to be a approving factor. It was just going to eliminate the score for being a initial yes or no answer, because your credit score is honestly just a tool for lenders. It's just a quick yes or no for lenders to let them know if they should waste their time or not with this potential consumer that's applying for a mortgage. And if their scores are above 620, they can move to the next step. If their scores are below 620, they don't have to waste their time, and maybe they should work on their credit. So based on removing credit scores from mortgage applications, it's stated that their credit profile will still be a factor, which means they're still going to look at credit card usage. They're still going to look at late payments. They're still going to look at collection accounts. So in my opinion, I believe this article is a little misleading, because I think it's helpful for those who don't use credit today and they haven't used credit in a while. Therefore, their credit scores have decreased over the last few years because they haven't financed anything, or they probably just paid everything cash. So for those people, man, that could really help them, right? Because they don't have to go get an unnecessary debt just to raise their credit score to purchase a mortgage or purchase a home. So, in my opinion, yeah, that would help out with them. But a lot of people, especially customers that we are helping in the credit repair industry, they see something like that, or they see the headlines of no minimum credit score required for a mortgage anymore. And people with 400 credit scores, and they got 15 repossessions and multiple bankruptcies on their credit, they're jumping up in the air right now because the headlines is a little misleading, in my opinion. So what do you think about that, man? Do you think that not requiring a credit score to apply for a mortgage is a little misleading or pointless if they're still going to view your credit report and many of the other things that's going to lead to factors that could reject or approve their application? How you feel about that?
Man, I think it's very misleading because I always tell my clients it's more about your credit profile than your credit score.
There you go.
So because the credit score is just a number, it's more
Right.
about your credit profile. So about the history and what you have going on. So still the fact of the matter is I think you're still gonna have to have good credit to get a
Oh yeah,
house,
for
because
sure.
you got to think nobody want to give $200,000 to a baby. So if they look at your credit score and don't see that you have anything going on, they still might not give you the loan. But at the end of the day, if you have the income to do it, and you probably can get by some of those credit rules, but you probably have to have a crazy amount of income though.
Right.
So that's not going to help out the average, majority of the population to me.
Absolutely. Yep.
So
The next thing, I just interviewed James Joseph. He's out in the Dallas, Texas area, and he owns bettercreditforyou.com. And I was speaking with him because he's very experienced with the mortgage industry and things like that. But Trump, I believe the White House or the Trump administration, they were trying to push a 50-year mortgage term. I don't think it ended up working because of the backlash and stuff like that. But, we have 15-year mortgages, we have 30-year, and then we had a 50-year. Now, two things sound crazy with this. So, going from 15 to 30 years, that's reasonable, that's realistic. But then going from 30 years to 50 years, man, there's some people who don't even live to see the age of 50, sadly, just due to health issues or something could happen or something unexpected, a car wreck or injury or anything like that, sadly. But the average age in today's world of someone buying a home is probably in their late 30s because of the
Hmm.
inflation and just how horrible the economy and stuff is. So if somebody isn't able to buy a home in their late 30s and then they're pushing for this 50-year mortgage idea, they're going to be almost 80. They're going to be past retirement when it comes to paying off this home. Now, I'm pretty sure banks have stipulations and they're probably only advertising that to people in their 20s and buying a home for the first time. And it's just a way to lock them in by saving a few $100 a month because they may be able to get approved for a home in their budget if it's at 50 years opposed to 15 or 30 years. But that goes back to my next thing. Going from 30 years to 50 years, I think we did the math. It's only like $200 or $300 difference that they're saving opposed to a 15 to 30-year loan. They're probably saving $400 to $600 a month. So, a lot of people are like, oh, well, a 50-year mortgage, they need to do this because it's impossible to buy a home right now. But then you have the smarter people that's looking at the numbers. And if you actually do the math, you're paying hundreds and hundreds and hundreds of thousands of dollars of interest to the bank if you finance a 50-year mortgage term. You're still doing that with 30 years, but it's like 3 times worse when you go from 30 years to 50 years. So how do you feel about the idea of a 50-year mortgage term? Do you think that's just completely insane, or do you think it's more helpful than bad? How you feel about that?
Man, I think it's a bad thing all the way around. I think it's a bad thing for generations. It's bad for the people. Once we make our lifestyle, we're able to be accustomed to it. We get accustomed to what's going on in our life or what bills we have. And
Right.
paying off a 50 mortgage. Most people retire at 60 years old. Most people probably buy their
Yeah.
house around 30. I'll
Right.
retire around 62, 60 or whatever. So basically, it's kind of setting you up. If you pay for 30 years, you on a retirement line that your house is paid for, and you can
Absolutely.
just move on. And
Right.
paying in a 50-year mortgage, you will never own that house or you can never pass it down because you still owe 20 years on it. Not saying if somebody passed out of 60 or whatever,
Right.
after the normal 30, you still owe 20 years on this house.
Exactly.
And then which family member is going to want to take a note that still has 20 years on it? You know what I
Right.
mean? So
Right.
you're not doing no justice for your kids and the kids behind you with a 50-year mortgage. And you're
Right.
paying, like you mentioned before, you're paying thousands of extra dollars for this house that, you could have just really budget down, got accustomed to, and paid that 30-year mortgage. And the thing that
Hmm.
people don't understand is, a lot of times when the economy go up, I mean, the economy, the money go up, our jobs go up or whatever, then,
Right.
the mortgage tend to seem cheaper than everybody else mortgage around that get a new house, you know what I mean,
Right.
after a
Right.
certain amount of years because of the equity in these houses.
Yep.
So at the end of the day, man, I think that's a terrible, terrible, terrible idea with 50 years. I honestly don't think it helped nobody but the bank because,
Oh, for sure.
because
Yeah.
you always under them. Like they got you by the chokehold, you know what I mean, to owning this
Right.
house. So 30 years is really pretty much perfect, you know what I mean?
Right.
And if you could do it in 15 years, if you could budget and do it for 15 years, imagine, you know, having the biggest expense paid off. You know what I
Yeah.
mean?
Yeah. For sure.
Instead of carrying the biggest expense for 50 years. That's
Yeah.
crazy.
Sturgis Credit Repair. Sturgis Credit Repair. If you want a new house, call us.